Okay. Does somebody have comments? Sorry, I can't see the chat. Cannot see. If you have comments, you have to just speak up because I cannot see the chat. I'm not sure why. Let's see if I can open here. All right. And participants. So we have almost everybody here, which is good. Okay, so let's look at putting this case together. So I mentioned to you, we're going to create the projection of cash flows. This is known as capital budgeting. And we're going to use net present value. Remember that the value of any asset, we've talked about stocks and bonds, and now, and in Unit 3, we talked about valuing projects. So we're going to continue with the idea of valuing a project as an investment opportunity. And to do that, we're going to determine the future cash flows. Or I'm going to give you the information, okay? When we get to Unit 5, you'll see that, well, anyway, in this unit as well, you have to think, I'm giving you the information. In reality, you'll have to make those estimations yourself, right? And the present value of those future cash flows will be the value of an asset. Now, if your assumptions are, if they're not strong assumptions or you doubt them, you should make another set of assumptions, compute another set of cash flows, and see if it really changes your decision. Okay, so this is like I call that sensitivity analysis. So remembering that cash flow in finance is not the same as
No se escucha bien, no sé si soy yo o le está pasando a todo el mundo que de momento no se escucha a la profesora. Hello,
I'm here.
es que yo no sé si soy yo. Ok.
Ahora no se escucha. No sé.
¿Verdad que no se está escuchando? Si alguien puede confirmar, porque no sé si es mi problema el mío o en realidad otras personas no escuchan a la profesora.
Yo no escucho.
Ahora mismo no se escucha.
Well, I'm not talking. I'm talking now. Is it hard to hear me?
Sí, se escucha ahora.
But is the sound bad?
No, era como se estaba entrecortando.
That's not good. Well, let me know if that's the case. Maybe I can move from
No,
where
pero
I am.
ya se está escuchando bien.
Okay. Okay, so keep in mind that depreciation is not a cash flow. However, the tax savings that accrue from reducing taxable income because of depreciation is a cash flow, right? So keep in mind that it's a different, and we'll look at that in a moment. That's a different treatment than you did in accounting. We're working with cash flows in finance. So still, the value of a project now is the present value of future cash flows. And we're going to see that also the value of a firm's equity is what we've been talking about so far is, valuing stock in a company. And sorry, I pressed something. What's that? Something happened. 1 minute. What is that? Sorry. I have a stray thing on here. Okay, well, you're just gonna have to ignore it. I don't know why that's showing up. Sorry about that. And as I was saying, right, cash flows is not the same as depreciation. We use dividends, the present value of dividends, to compute the present value of stock. So anyway, we need to figure out the projection of cash flows to value a project, keeping in mind that depreciation is not a cash flow. So when we began looking at the case, we were reading about which cash flows were incremental. So this is just an overview of what was said, that to calculate the net present value of a project, we're only going to use incremental cash flows. What is an incremental cash flows? It's a cash flow that occurs as a result of accepting the project. It's not a cash flow if it occurs independent of that decision. So for example, any money that's already been spent, we call sunk costs. Whether we take the project or not, we can't recover those costs. Okay, that's so that was in our example. Marketing survey done 2 years ago would be a sunk cost, or any research and development expenses spent previously. Opportunity costs are incremental cost cash flows. However, what's an opportunity cost? Well, remember I mentioned, we discussed the airline having a vacant terminal to park the planes, and it sounds like, oh great, we're going to save money because we have a vacant terminal, but in fact there's an opportunity cost to using a vacant terminal with a market value. The market value is an economic cost, and we should include that in the valuation of the project. Some more examples include, let's say you work for General Motors company, and you are producing a new truck, or you're looking at producing a new truck, and in your capital budgeting exercise, you should consider any buyers that would have otherwise bought a different model SUV you already have. So you're going to lose revenues because of those other those automobiles not being sold, right? Because the customers are going to move to buy the new product, the new truck. So that's also an opportunity cost. Sorry, opportunity cost. What am I looking at? I'm looking at side effects. Sorry, the opportunity cost. So this is the thing. Okay, sorry, I slipped in my visuals here. Opportunity cost and side effect are very close, but I'm going to distinguish between this example that I just described. It sounds like it's an opportunity cost, but we're going to give it a specific name as a side effect because it affects another project of the firm. For instance, the SUVs that are a current project of the firm is going to be affected. So that SUV production and revenue that stems from it is going to be adversely affected. So that's a side effect. A opportunity cost is when we talk about having underutilized equipment or space. For instance, in our example, we talked about the terminal, and this is another example, a machine that's required for a new project, but it's available, not being used. Well, that machine had a value, the market value, and we need to consider that an economic cost when we create the capital budgeting projection of cash flows for this project. Similarly, a building, if we already own an office building, we could have rented it. And because of that, the market value of those revenues need to be considered as a cost. All right, back to the side effect, sorry. So side effect would be the example of the GMC producing a new truck that attracts customers away from an earlier model. Any advertising of a new product that increases sales of an older product, that could happen. Let's say a manufacturer of shampoos or beauty products that produce shampoo puts a new ingredient into a shampoo and also attracts customers to their conditioner, right? The conditioner, the rinse that's used with that shampoo. So that's an older product gaining, realizing greater sales or more revenues because of a new product being launched. So this is a positive side effect, actually. This is a positive side effect. This one is negative. My writing is really messy. Let me try that again. So this is a negative. This is a positive. And this is also a negative. This situation is where you have, as a result of a labor shortage, so we presume, if we are to presume that the economy is at the natural rate of unemployment, or that there's no, basically there's it's going to be hard to find excess labor, right? So let's say everyone has a job that's pretty much looking for a job, which is not the case. There's always an unemployment rate. But let's say to attract people to your project, skilled labor will look for a wage increase, right? So to be attracted from their current work to your project, you'll have to offer more money than is currently seen across the industry. But that's going to have an adverse or a side effect impact on you, because you have other employees and you can't just pay the new employees more, right? It might across the board affect your expenses in wages, and that might be indefinite. That might be forever, because it's really hard to lower wages once you've increased them. So that's a negative side effect. So these are all incremental. These two are incremental as long as they result from taking on the project. Allocated costs. If you hear about allocated costs, they could also be incremental as long as they're due to the project. Okay, so in this example I've posted here, as long as the allocation or the costs associated are due to the project, they'll be considered incremental. Otherwise, they won't. All right, so I'm going to talk about this example after I get through the case, because it's kind of separate, but it's important. All right, so this is where I want to start. So I mentioned to you that each of the incremental cash flows we identified in the case, I numbered them 1, 2, or 3. Remember why? What did I say? This is not it. Maybe I did it. This is it here. I didn't number them for you. 1, 2, or 3. You hear me? So 1 would be the cash flows for income, 2, the cash flows from investment, and 3, the tax shields or tax savings resulting from reducing taxable income when as a result of expensing depreciation. These 3 is what we want to work with, and now I'm going to justify how I can do this, right? I can separate these. And what we really want to calculate is not accounting income. We want to compute cash flows, right? So cash flows would be net after tax operating cash flows, to be specific. Net after tax. So this is net after tax. Is everybody fine with that? So revenues minus operating costs minus taxes. This is my first formula. Okay, revenues minus expenses minus taxes. Well, what are taxes? Taxes are computed by TC times the taxable income. Taxable income is revenues minus expenses minus D. What do you think D stands for? What is D?
Depreciation.
Nice. Yes, depreciation. So you have the benefit, thanks to the IRS, Hacienda, that allows you to depreciate assets that or equipment, buildings that you've purchased to carry out your business. So you can claim wear and tear on these assets as an expense at a faster rate than they really depreciate. So you can have an incentive to buy what's the word? Non-durable goods, right? Your non-durable assets. They're going to wear and tear. Well, government's going to give you an incentive by allowing you to expense and reduce your taxable income. And that can, you'll see, result in a lot of money. So you have revenues, less expenses, less depreciation. So this is your taxable income. Now what's TC?
The tax rate.
Yes, what's the C stand for? Corporate is a corporate tax rate. Okay, so this is, this is like corporate finance. We're working with the corporate tax rate. So this is the corporate. Now, depending what country you're in, that can be high, that can be lower, relatively speaking. Okay, so that's the corporate tax rate. That's the C. Now, there's different tax rates. I'm not going to go so far in this course as I'd like to talk about the different tax rates, because there's also for investors in companies that are affected by the corporate tax rate, because investors in companies get the residual profits, they care about this rate, but they also care about the tax rate that they pay for, or the tax rate they have on any dividend income, right? So if they have shares or stock in the company, they have to pay tax on that. So that's an important tax rate as well. And if they're bondholders, they have to be concerned about any interest tax rate on interest income. That was an attractive feature of the municipal bonds of Puerto Rico. Investors didn't have to pay taxes on interest payments from that kind of investment. So the tax rates are really important, and I'm signifying this specifically as the corporate tax rate. Okay, let's put this amount in here and see what happens. Are you with me? Is this interesting to you? We're going to put that in here. Now that leaves us this. Now this is not very interesting in this form. What I'm going to do is I'm going to put together this, which we can call net revenue. This is net revenue. And now I want to factor out net revenue. And the way that I'll do that, I'm going to put it over here with black. So net revenue minus TC times net revenue plus TCD. Does everyone see what I did? So I multiply these and then I distribute TCD. I can do that, right? It's going to go here. But then negative TC times negative D is positive. So all these notes that I show you, they're all on the platform. They're all on the platform. And now I want to factor R minus E because I want to show you something. So factoring R minus E, net revenue, that leaves a 1 here minus TC. So this is here. So this is net after tax, right? This is net revenue after tax. It's not operating cash flows though, right? Because I didn't put the D in there. It's just without the D. Earnings before depreciation is what this is. And I separated it from this piece. Why did I do that? Well, I'm showing you that I can look at revenue separate from the tax shields. And notice, because of depreciation, the higher the amount of depreciation you can claim each year. This is an annual statement, right? This would be annually. I want to do this. The higher the depreciation amount, the more net operating cash flows we'll have. Okay, so this gets added. This is a result of lowering the taxable income. This is how it works out. So it's mathematically, it's a surprise, right? But it's a nice way to see things separate. So what we're going to do is we're going to use this approach. We're going to get the revenues, the expenses. We're going to calculate them after tax in each year, and that we're going to do that for income. We're going to do that for investment, and then we're going to add the tax shields as a result of depreciation. So those are going to be why I do 1 plus 2 plus 3. Are you with me? You see the math? Now, I don't expect you to see that on your own, but this is the result. This is just an example to show how, as a result of depreciation, this is like your income statement. The net income is different Then the cash flow, okay, with depreciation. This is different. So it's higher, right? So keep in mind that tax flow is equivalent to cash inflow. To determine the D, I'm going to show you how to use the IRS rules for depreciating assets for tax purposes. These are the elements of the case here. So have a look at this, and you can ask me questions about that after you've looked at that. These are the elements of the case that we already discussed. Remember, it was about the 4 planes that are going to be purchased to fly to the Bahamas for 4 years. We're not going to include the marketing costs because that's sunk cost, right? We have the capital spending from purchasing the planes. We have the round trip tickets anticipated with the ticket price and the operating costs. This is revenue, this is expenses, and these are the units that we're going to that are going to be purchased, or we assume they are. These are the lost sales, remember? Because passengers are now current customers are going to abandon the other destinations and instead try the Bahamas. So this is what we anticipate each year. We made it easy, right? The numbers are all the same, but you could try varying them and see if your conclusion changes very much. These amounts are from the table of net working capital, assets and liabilities, right? Current assets and current liabilities. I'm going to show you how we derive these numbers from the numbers I've already given you. This is all about the terminal, which can be used for the Bahamas project that the company already owns. And this is the market value opportunity cost, $10,000. Why did I write 10,000? It's $10 million a year, right? It's 10,000 K. And this is the salvage value, residual value of the planes we discussed. Here is the discount rate. This is given to you, and they give you the tax rate. It's quite a high tax rate, isn't it? So you can see the higher the tax rate or the higher the D, depreciation, it'll increase your net operating cash flows. All right, so here are the results for the first piece, income. These are in millions of dollars. No, well, they're in thousands of dollars. So 32 million in sales revenues will result from, oh, sorry, where's my, okay. So these are the tickets times 2,000. You add 3 zeros and times 2, that's 32 million. This is 48 million. This is 30 million, and that's 22 million. That's where those numbers come from. $44 million. Okay. These are the lost sales. These are negatives, right, with the brackets. So these are lost sales as a result of the side effect. $2,000 each for 100, 200, 400, and 300. In other words, 200,000, 400,000, 800,000, and 600,000. What about the cost side? We have opportunity costs, $10 million each year from the terminal being owned by us. The variable cost of flying passengers to the Bahamas, so it's going to cost something. That's these amounts times 1,000, so now these turn into millions. And tell me about these amounts. What are these?
Are those the side effect of the last sales?
Right. So these are the lost sales, but these are the lost expenditures, like the lost, this is a positive, right? Because it's a negative cost. So this is cost savings. That's another way to say it. These are cost savings. Because we don't have to fly those people. We don't have to spend money on flying those people. Cost savings. Okay, so we understand all the components. Keep in mind, I've given you all the elements of the case. There might be other things that have been ignored here, but these seemed, these are the ones I gave to you. These are the ones you analyze. If you were responsible for coming up with the components that compute, that help you compute the revenues and expenditures, then you'd have to do a little more work to find those out and implement them or include them. But this is what we have. So let's add and subtract these. Add and subtract these, add these, subtract these, and these are our amounts. Now go for the taxation. So these are the cash flows for income in thousands of dollars. All right, so take those cash flows, put them in your calculator at 10%, and tell me what is the present value of income or the NPV of income. I'm using those interchangeably now. You can put it in the chat or you can tell me.
Son los 5.900 para el 10%.
I think it's too high. What did you had much? How much? This should be the answer.
Es que son.
So verify that you can get that answer. So I can then talk about it and continue. Sandra, looks good. Very good. So this means that net income in present value terms are almost $24 million. So we're not done because we have to consider investing in the project. What's the present value of investing? We need to calculate now the present value of the investment cash flows, ICF. Any questions about computing this value? Am I losing connectivity? It's like my signal is low. Okay, you've been quiet. All right, so let's look at the next piece. Let's look at income. Okay, let's go back to our, let's go back to our list. So now we've dealt with this piece, this piece, this piece, this piece. Now we have what's remaining are investment, the cost of the planes, and the net working capital cash flows, and the residual value, salvage value when we sell. No, that's not it. We did that already. Sell a plane. So notice all the red were in income and just a few in the investment piece. Now, the reason why I separate them, you'll see, is because the way that I deal with tax is I get the earnings before depreciation and tax, and then I tax. Oh, I guess I should write that out, what that is, because so this EBDT stands for, let me erase this too. So that stands for earnings before depreciation and taxation. And then we do it after tax. So it's not earnings that we're interested in, right? Earnings before depreciation is what we're interested in. So let's do the investment piece. And hopefully it doesn't exceed this amount, right? 23 million. To do the investment piece, we need to take the, let's take this sheet here. So we need to take these cash flows and compute adding assets and subtracting liabilities in each year that's how we'll start. And what we're going to get from that is called net working capital requirements. Now, net working capital, you see, is made up of cash, and really these are short-term considerations. This is like a float, money we have to set aside to constantly have, this inventory. We want 600,000 inventory immediately. We want to have $1 million in cash up front because this is year zero. This is right now. Accounts receivable, we want 1.3 million. And for accounts payable, we need to have set aside 1.1 million. That always has to be, once we use it, we have to replenish. We always have to keep up with that amount, right? So throughout the year, by the end of the first year, this is what we want to have. So we need an additional 250,000. We need an additional for cash. We need an additional 55,000, and so on. So how do I take care of this? My requirements first, let's calculate across the row, add and subtract all the way across. Noticing in the last year, we end the project. When we end the project, we no longer need this operating amounts, right? We don't need this cash flow or these assets and liabilities set aside for this project. So we just release these amounts back to the firm. So let's add up, subtract. What do you get?
The first one will be 1,600,000.
Very good. And end of year one.
That will be 2,400,000.
End of year two.
$7,600,000.
How much?
It's 3 million.
3 million?
Yes, it's 3 million.
Okay.
And 2,200,000, exactly as Sandra Rightford in the chat wrote.
Okay. Very good. Let's see. So let me make sure it's correct because I have the numbers here. Okay, so now you know where those numbers come from. Now, what you have to do is compute the incremental amounts in each year. In other words, the changes in net working capital, investment. I'm just going to take it, let's leave it like that. Change in net working capital. So immediately you need to set aside 1,600,000. How much more do you need by the end of the first year?
The difference will be, 800,000.
Right, and then the difference here?
$600,000.
Right, and then the difference here?
That will be a negative.
Right, and then here also negative. So it means that,
800.
right. So these are negatives indicating that you no longer need the funds, you no longer need the cash flow to be allocated to this project, and the money goes back, right, to the other projects of the firm. All right, so we have to do one more line because what our perspective is reversed. I've been talking about the needs of the project, but I really want to know from the firm perspective, what is the investment? So we're going to call this investment cash flows. Okay, so these are the investment cash flows due to net working capital. all I want you to do is think about this. This is an investment, so this should be a negative. Yes, I need 1.6 million for the project, but it's a negative because it goes out of the pocket of the firm into this project. So it's just philosophically, let's look at it as cash flow. Like it's our project, but it's going out of pocket to these operations, right? Now this amount will come back to us, and this amount as well into the firm as positive. And these amounts are what I need to put in my table for investment cash flows. For investment cash flows, yeah. Okay. Notice I haven't said anything about taxing. This is just operating the business. There, I have not said anything about after-tax amounts. All right. So this is how it's done. I don't need to. I haven't talked about expenditures and revenues here. This is about the investment in the project. And I'm going to put those amounts. So this is just what we just did here. Let me just show you the table. So this is the table on page 18 or slide 18. This is like number 2, right? Part 2, investments in thousands of dollars. And here are cash flows. These are all negative. So investments in the first 3 years or in the first 2 years and immediately. And then these are the funds, the amounts released back to the firm. So those are positives. What else goes into here? Well, we have to purchase the planes, 40 million. And then here it shows that we're going to sell the planes and in the 4th year, realize a revenue of $12,000, but we don't put it in the revenue table. We put it here, okay? I'm going to show you what number you have to put here because if we sell the planes for more than they are worth in our bookkeeping, then we have to report, or we're going to realize a capital gain, right? So if we sell them for more than their book value on paper, in other words, we've depreciated them so much and realized tax savings, but if we sell them for more than it says in the books, we have to pay taxes on that, okay? Because we realized a capital gain, and that's revenue that gets taxed. If we sell it for less than it is on the books, then we actually can claim a loss and we can realize tax savings because of that. So we're going to deal with this number in a second. Let's go back. We have to find out what is the book value. So let's look at that. This is this table here. So we finished this on page 13. On slide 14, let's fill in this table. Now this table, what you should put on your formula sheet is the first or the heading of this table. So you should add this to your formula sheet. All right. That I'm going to put year first. Notice we start after 1 year because we need time for the item to depreciate, in this case, the planes. This is little d. This is the rate of depreciation. I'm going to show you where I got that from. This is the big D. The big D is how much I actually claim for wear and tear of my asset. And it's computed as this letter D, this number, multiplied by the 40 million each time. Okay. All right, so where did I get these numbers from? These numbers come from the maker's table that I'm going to share with you. But in fact, I'm just taking it from the IRS. Let me see that I have it. Oh yeah, I have it open. Great. So this is in the platform on Moodle. You can get this kind of table through the IRS. It's in the textbook. Should be a version of it in the textbook. And different assets have different years. So items, assets that depreciate slower, like buildings, are going to have longer depreciation period, like 10 years or 20 years. Electronic equipment could have like 5 to 7 years. Furniture can have like 3 to 5 years, depends. So you have to read about the description of the asset class. So I've been using a lot of 7 in my examples because I refer to electronic equipment. So planes would fall under that. And so we're going to use the 7-year period of depreciation, and these are the values that work there. Now, planes can depreciate about 30 years before you scrap them, as explained in the case. But you see, within 7 years, we can claim all the wear and tear of the planes and realize tax savings. But we're actually going to end the project after 4 years. So there's a lot of numbers floating around, okay, in years. We're just going to use 4 years, even though it's a 7-year period till we fully depreciate the asset. All right. Now there's some other rules and details about the pools in the assets, and I'm not going to get into those details too much. I'll give you the chance to read about that when you do the assignments with the textbook. I'm not going to stress that right now. Okay, so what you need to do is calculate the depreciation. Notice all you do is 40 million times this number, and you'll get 5.7 million. Now that's a lot. $5 million that you can claim as a loss because of depreciation. In terms of tax savings in our calculation, TCD, you save $2.288 million in taxes. So that's a lot. So you want to do this right. Okay. So once you have that number, find the UCC. UCC stands for my writing is messy again. Undepreciated cost of capital. Now, I don't want you to just rush and make this table. Let's go step by step together. So this says that the value of the plane, the book value of the plane after year 1 is 34,280,000. So you move this forward and you'll see what happens next. But the way this number has been calculated in the first year, I mentioned to you that this is half of 28.6. So all these numbers have been calculated to make this really easy. So you're basically, it sounds like, you're depreciating 30% in the first year, but they say you can only do half, and I explained, or I think I explained that if you have this provision where companies can depreciate an asset, then they'll wait as long as possible to purchase that asset so that they can begin the next year with a new asset, yet realize, almost $10 million, if you use this number, in depreciation. So to disincentivize and to spread out business activities throughout the year to encourage economic activity and economic performance or stability in society, economic stability, you want to spread that out. You don't want everybody, all companies purchasing assets just in December, late end of the year, right? So to discourage that from happening, they only allow half of the depreciation. And yeah, so that's why it's half. But then from this amount, it's double declining. It says this number has been calculated to take account of the fact that this amount went down. And all you have to do is take this number and multiply it by 40 million to find out the next amount. So what do you get? What's the next amount?
$9,800,000.
9,800,000.
Right. And then what does it leave? So you're going to take this amount, subtract 9,800,000 and put it here.
Yeah, 24 million. Or yeah, it's not a negative. It's a, that will be 480,000. 480.
Yeah. Okay, and continue then with the next row. We'll leave the column. We'll deal with this later. Okay. So you guys are doing this. So I'm going to cheat and get the values from here. Keep going though. Keep going. All right. So that's what you should have. Does it look good?
Okay.
Good. All right. So so this amount, this is what I wanted. I did this entire, I filled this entire table to find this amount. This is the book value of the planes. we've depreciated the asset. This is, and you'll see in a second that you realize tax savings, and this is all the asset. And according to the authorities, this is the value of the asset that remains. $12,480,000. Now this is for 4 planes because we put them all together. This is the book value. This amount up here, so remember these are the elements of the case. This amount here is known as the market value. We need to multiply this by 4, and what do you get?
$12 million. It's the same as the book value.
Yeah, it's the same. Now it doesn't have to be the same. Okay, this was made the same to simplify this exercise because there's so many components, but it doesn't have to be the same. In this case, it was the same, and we'll talk about the fact that this is what you can sell it for, sell the 4 planes for after 4 years. This is what is on the books, so it means that you will not realize any difference. There will be no capital gain. There will be no capital loss. So there's no tax treatment of this amount, right? So we needed to check. We did this just to verify that all we have to put in our table is 12,480,000. And so that's what we do. We put that here. Now I'm putting everything in a table, and it's important to be able to work with the tables. But when these terms are similar, when there's a pattern, we can return to our annuity formulas, right? When the cash flows are level, we see a pattern, we can use our annuities, and you'll see in the examples I give you also perpetuities for some elements that are infinite or indefinite cash flows. All right, so we have this amount. Let's talk a little bit, just a moment, about what if they weren't the same. So they were the same, but in general, if the book value exceeds the salvage value or the market value, right, you sold it for less than it's worth, you have capital losses, so you have tax savings as a result. If the book value is less than the salvage value, so you sold it for more than it was worth, or on the books, capital gains would be realized, so you would pay taxes. So to compute what you would actually see in the 4th year, at the end of the project, you calculate the salvage value plus this difference. Okay, now for our case, they're the same number, so there's no tax effect. So this formula also should go on your formula sheet. You have to understand it, but that formula should also go on your formula sheet. Okay, so we didn't have to add that this time, but yeah. All right, so do we have all the pieces? So we talked about net working capital investment, the purchase of the planes, the salvage value with no tax, any kind of tax effect, you put it here as well. Add them up, and these are your total investment cash flows using the present value or NPV formula. What you find out is investment costs $32 million. Let's remember what was the revenue? Net operating cash flows. We go back 23 million. Where'd it go? Didn't show up. Anyway, it was 23 million net operating cash flows, but for income, right? The present value of income. But investment is 32 million negative cash flows. So we really are counting on the last piece, the third part, the tax savings, to put us over the top, to actually realize a profit with a positive NPV. So let's check, where did these numbers come from? And then we'll calculate to see if we make enough money. So those numbers come from here, this last column. The tax shield is just calculated as the tax rate times D. Remember, I showed you where I got this from back here. Right here. Okay. So that's the tax shield, part 3. So to calculate it, you just take the D, this column, and multiply it by TC. Now you see, you can do this. You can set this up in Excel to make your tables. If you want to submit your calculations and tables during a test or for a test, well, you guess you can't for the test because you're going to do it in class. But if you're doing your exercises, you know, you're practicing, you can do it in Excel, right? And set up these formulas in Excel, and this makes it easy. If we were doing a test or assignment that you submitted to me, then you would have to send me the Excel spreadsheet. But as it is, practice either in Excel and by hand in preparation for the test. So let's calculate these down here. What do you get? 9.8 million times 0.4, TC is 40%. So what you're going to get are these values here. So verify that multiplying this by 40% gives you this, 7 by 40% gives you this, 5 million times 40% gives you that.
Yes, it gave me those numbers.
Right.
Same here. I got those numbers too.
Okay, good. So oh dear, just all right. So those numbers, I'm just trying to bring them here, but it wasn't so easy. Those numbers are here. I'm going to take the present value of these cash flows, and I get 8.789 million. All right, so put together 1, 2, and 3. Let me get 1 back. I'm going to try it again. Just to remind you, this was 1. I'm going to put them all together on a page here. And then these two. Okay, so you see, this is the investment piece is more than the Revenues, net revenues. So you actually need to depreciate them, the item, the asset, the capital spending, in this case, the planes, to make this project a positive NPV project. In this case, you put it all together and you get 285,318 cents, which is greater than zero, so you invest. The conclusion is accept the Bahamas project. Any questions? All right, so we've solved one case, the one we began with. And you could do it this way with a table, 3 parts, calculate the 3 parts separately, add them up, and see if they're greater than 0. Another thing you can do is just take the final set of cash flows in each of the 3 parts and put them together by turning them or converting them to a stream of cash flows like this. So this is just the first box, the second box, and the third box. And this is equivalent to the cash flow, the examples where I give you a set of cash flows and I ask you to solve for the NPV of the project or the IRR of the project. So as now you have these cash flows, compute the internal rate of return, which you can do. You couldn't do that over here, right? You can't just get the IRR of each piece. That doesn't make much sense. You have to get the total project cash flows, calculate the IRR for the total project cash flows. Do you have the IRR?
Is it 10.26%?
Right. So, and then we can conclude. Since this is an investment project, right, the first cash flow is negative. So this is investment project. We interpret the internal rate of return as a rate of return on the project. The rate of return on the project exceeds the required rate. So we should also accept the project. We should get the right answer, the same answer as we did for the NPV, the same conclusion, but now we have an IRR to work with. In case we're not comfortable with the required rate that we chose and we're uncertain, we know that this project's rate of return is estimated as 10.26%. Okay. Questions? Any questions? Any confusion of what I did? You need to practice. I set up several exercises for you to practice. I think I did. Let me verify what I have on the platform for you. So I have 3 courses that are the same, and I sometimes don't feel confident in saying that I did it for sure. So let me double check. That then. There you go. So yes, you have all the exercises there you can practice. I have an old exam that you can review, Unit 3 material and Unit 4 material. Maker's table, the lecture notes. All right, so what I want to talk about, if you don't have any questions, for a moment, let's talk about the inflation exercise, or an example here. Now we saw this before, right? We talked about inflation, and in doing so, I teased apart the real rate from the nominal rate. So, and I insisted that all the rates and the cash flows that we've been looking at till that moment were nominal. Once I introduce inflation, we can separate apart the real portion, the real rate of interest. So we come up with this relationship and say, this is the relationship between the nominal and real rate. The real rate is defined, or it's determined by the supply and demand in capital markets, represents the cost of borrowing. The nominal rate is the real rate adjusted for inflation. So we learned about this relationship, which was important because most people think that it's an additive relationship, but it's not additive. It's multiplicative, and there's a growth factor or an inflation factor, 1 plus. That's how we deal with rates, right? 1 plus, 1 plus. And that's how they relate to each other. We also learned that to calculate the NPV of cash flows, if you have nominal cash flows, you should discount them with the nominal rate of, or the nominal discount rate, or the nominal rate of interest. For the real cash flows, you should only discount them with the real rate. And computing one for the other is done using this relationship. So just a moment to say that the higher risk cash flows should have a higher discount rate. So we talked about that. We talked about stocks and bonds, and whereas bonds, well, at least treasury bonds by the government are guaranteed by the government, so they actually have a lower risk and a lower rate of return. To incentivize, and you'll see this in Unit 5, we'll talk about it more explicitly, to incentivize investors to take on risk, investors need to be not promised, but they have to anticipate a higher return. Now, with stocks, that can't be guaranteed. There's no guaranteed return when you hold stock in a company, but all the more reason why the return on stocks, as seen as a dividend and an increase in the market value of a share, that return is higher than any, usually higher than any bond, and certainly the treasury bond. So we'll talk about that more when we get to Unit 5, but that's what this is hinting at. All right, so let's see an example with inflation. So you have $2 million right now. You could either invest that money in financial markets and realize a 4% return with no inflation, or you could go to the housing market. And currently, this example shows that the housing market has a nominal interest rate of 4% with inflation of 5%. So what does that mean? What are the consequences? It means if you're in the market for a home in Beverly Hills, so this is the inflation rate in Beverly Hills housing market specifically, I didn't specify that. Should you buy a house now if you're in the market for a home? Well, if you don't buy and instead invest your money in the financial markets, you'll have $2,080,000 after a year. Now, it sounds like a lot of money, but you will be out of the market in buying a home next year because the price of a $2 million home went up to $2,100,000. So you'll be $20,000 short. So what's happened is this differential shows or demonstrates that the real value of your money has depreciated, okay, in the housing market in Beverly Hills. So let's see what that looks like. Let's look at the Fisher relation and look at the real rate of interest. Rearranging things, calculating the real rate of interest is actually a negative. So this means like you're actually, giving away money, right? To invest if you were to invest in financial markets over the housing market. To elaborate on this example, let's look at the real cash flows and the nominal cash flows with the real rate and the nominal rate respectively. So we have, in terms of, remember this relationship too. So there were three relationships that we talked about, right? This cash flows from real to nominal. Cut out. Can you hear me?
Yes. First,
Yes.
se empezó a entrecortar y luego se cayó la llamada.
Yeah, I'm not in a good place right now. Let's see. And why I can't seem to put up the okay, let's do it this way. Okay. All right, so I was saying, let's put the real rate with the real cash flows and the nominal rate with the nominal cash flows and see what that looks like. What rate should we use? Well, the nominal amounts, let's be clear, would be $2,000. So in nominal terms, in what I actually have to spend to buy a house in Beverly Hills, it's $2 million today. and I would actually have to spend $2,100,000 because of inflation next period. So the NPV of buying the house is $19,230,77. I can get the same answer using that real rate of return or real discount rate with the real cash flows. Now look, $2 million house at time 0 is still a $2 million house at time 1. That's what, these are the real cash flows, okay? They're the same. You'll get the same answer. So this is just an example to emphasize or reiterate this point about using nominal cash flows with nominal rates. Now, why would we like to see real cash flows versus nominal cash flow? It's good for planning, right? It's good to put in, because I know what I want to be able to buy. And that's what this captures. I want to be able to buy a house, right? And that's $2 million at time 0. So in real terms, that's $2 million at time 1. So I mentioned that because in the last exercise, all that we do here is compute the nominal cash flows, taking the nominal cash flows we already computed, converting them to real. And we use this expression to do it, and given information in the case, if you go back to the initial case, there's information that there's an annual inflation rate of 4%. So you can calculate the real cash flows. And then notice I only use the income and the investment cash flows and convert those to real, because the tax shields, it's not common to think of tax shields as anything but nominal cash flows. Okay, we don't think of them as real cash flows anyway. They're a stream of nominal cash flows. They result from tax savings. And that's different from what we've done here. So you'll notice that the results are exactly the same. I get the same number if I do everything properly, using the real cash flows to calculate with the real rate, and I get the same values. So anyway, it's just an exercise to remind you about if you wanted to present this data to anyone in a report in terms of real cash flows, because they're more comfortable looking at 3,403,000. Sorry, this is in millions of dollars, right? So 3,403,850 in year 1. They feel more comfortable with that than looking at it over here. The real rate, did I even calculate the real rate? That's funny. It's right here. So if there's 4% inflation, the real rate would be 5.7, approximately 77%. And you get the same results. All right, so any questions about what I've done here? You have several exercises to work on this week. I encourage you to go through them. I'm going to post your grades. I'm going to stop now. That's want to give you some time to work on this on your own if you haven't already. Has anybody gone ahead and worked on these, or have you been busy with other classes? So these cases they're all very similar. By the time you get to the fifth one, you should feel confident about what you're doing. Try and solve it without looking at the solutions. I have some additional cases that I'm hiding here, but if we need them, I can add them. But you'll see some of these exercises are quite short, and I give you instructions on how to calculate things. Here I introduce the 15-year depreciation schedule for practice. All right, so any questions for me? Any questions of any of the components here? What I actually do is I simplify things. So in some of the exercises, maybe this one, I ask some simpler problems. This is the case here. It's not a whole page. Number 2, it's a very simple case. I mean, it's a smaller case. And notice that the amounts here are level. And I take advantage using annuities to calculate things as opposed to using an Excel table. If you like the Excel table, you can stick with that, but it's going to be much easier to use your annuities. So practice the material from the first test. I'll send information about when I'm going to seat the retest, and I will post the exam solutions with, or the exam answers with the exam grades after we get off here. How does that sound?
Thank you.
All right. So keep in touch with me, and we will, okay, next week, our class is repeatedly interrupted by administrative affairs, and it's going to be, I think, another assemblea next week. I'm not sure if that's going through, or anyway, I will keep you posted on what's going on, but you just keep studying, right? We can get together. I'm going to be away this next week, but the following week we can meet in person. That will be the 18th of April. So I'll send a message about that too. So we'll plan to be together the 18th of April. Pending any closures or shutdowns or interruptions, I always have to be aware of those. So we can get together in classroom and solve some cases possibly before the next test. The next test is yeah, we still have time. So that'll be a week before the next test. That'll be good. Okay.
Professor, the next test will be unit number 3 and number 4.
Unit 3, unit 3, number 4. Sorry, unit 3 and 4. And then I want to start 5 and 6 will be for the final exam. Yeah. The final exam should be, I have to look at the schedule. They sent the schedule. I didn't have a chance. Did you see the schedule for the final exams? Anyone?
No, I haven't seen that. No.
I think it's a draft. I don't think it's for the students yet, but it should be between the dates I posted. So, yeah, we're going to have to probably just finish unit 5. We've been interrupted so many times, and I don't know what to say. It's unfortunate for this class. I really hope you're learning something. But let's see, on April 17, we'll get together. In the meantime, work on all the materials as much as you can, what I've given you. And then we'll talk about having the makeup test. We can do the makeup test after the second test. How does that sound? So you can focus on unit 3 and 4.
I believe it sounds good. I think it's okay.
I cannot hear you, but did you say it's okay?
I believe, yeah.
Yeah, okay. Sounds good to me. All right, so I will be in touch. I see somebody wrote things. Okay, so let's be in touch about those sort of 3 things, right? The test, the meeting, and I guess the final exam too, the dates. So I'll be in touch with you. Okay, so have a good study session the next week or so. Well, pending the interruption next week. We're going to aim to meet on April 18th anyways. So look forward to that and open your schedule for that, please. Okay? Yeah, I'm going to
Okay,
put the grades
thanks.
on Moodle now. Yeah, because I have them ready to post with the last 4 digits of your student number. And I will also post the solutions of the exam so you can think about where you went wrong. Okay?
Okay, thanks.
So have a
Thank
good night. Good
you.
week. Ciao.
Good night,
Thank you as
Professor.
well. Good
Good
night.
night. Bye.